Good afternoon. Thank you for joining us for Managing Volatility in Chaotic Markets, a one-hour webinar developed by Index Universe and sponsored by the ProFunds Group. My name is Dave Nadig, and I'll be your host for today's webinar. For those of you who don't know me, I'm the Director of Research here at Index Universe, an ETF-focused media company that produces IndexUniverse.com, the Exchange Traded Funds Report, which is the Inside ETFs and Inside Commodities conferences, which are the largest ETF-focused conferences in the world. Today we'll be talking about volatility. Over the past few years, we've seen record volatility in the markets, resulting in huge shifts in price momentum. But what really drives volatility? That's the question. And is all that volatility bad? We'll be taking an in-depth look at how volatility affects a portfolio, as well as some of the ways investors can turn volatility into an opportunity. The format for today's webinar is simple. We'll start off by digging into what volatility really is, including its drivers and its influence on portfolios. And then I'll kick it off to one of our panelists, Joanne Hill, who will explore whether or not the markets have fundamentally become higher risk for investors. And then I'll close out the presentation with an explanation of how we're measuring volatility and some various options available to investors who want to capture volatility in a portfolio. Joanne and my presentation will be followed by an in-depth roundtable discussion between myself and Joanne and Tim Collins. Joanne, if you don't know, is head of investment strategy at the ProFunds Group and one of the leading thinkers on volatility and portfolio strategy in all markets. Tim Collins is on the investment side, where he's the founder of Tangle Trade Management and a columnist for Real Money over at thestreet.com. Tim probably knows more about volatility and sophisticated ETF portfolio strategies than anyone I've ever met. We've had him on before. It should be an exciting hour. Before I get started, though, let's go over a few quick housekeeping items. As a participant in this webinar, you can submit questions to me or my panelists at any time during the presentation by entering them into the Q&A window on your screen. We'll collate the questions, and we'll answer as many as we can get to during the Q&A period. A replay for this presentation and a copy of the slides will be available both at indexuniverse.com and at ProFunds within a few days. For those of you who are viewing this live today on July 29th, information on how to apply for CE credits will be contained in a follow-up email. With that, let's get into it and start talking about volatility. So what really is volatility? When you read about it in the newspapers or when you hear about it on CNBC, there are even ETFs and ETNs that promise to capture volatility for your portfolio, but what do we really mean? So this is the classic textbook definition of volatility. It says that volatility is the standard deviation of a security or an index or some other asset class over some time period. In other words, it's a statistical way of measuring risk. The higher something's volatility, the riskier it supposedly is. That textbook definition is important, particularly those words standard deviation. People gloss over words like standard deviation, but they mean something really specific, and it's probably worth just reiterating. One standard deviation captures about 68% of the variance in any set of numbers, in any set of returns. To heck with the outliers. It's all about capturing the middle. In other words, volatility doesn't capture the best or worst outcomes. They capture something that is sort of like the best and worst normal outcomes with quotation marks around normal. Even events like the flash crash are really just not predicted or even particularly well measured when you're talking about standard deviation and volatility. So let's dig a little deeper. Now, they tell me that putting an equation on a PowerPoint slide is pretty much a sure way to kill off any audience, but I'm inclined to use this one here because I think it's important, and because I think those of us that don't even like math can learn a little something by just looking at what's inside this equation. This is the standard equation that defines volatility, and I just want to point out three things. The first is that the differences in return are always squared in this equation. As my 12-year-old daughter could tell you, when you square two numbers, even two negative numbers, you always end up with a positive result. That's important because it means when you read any statistic of volatility, for the most part, it's going to treat positive returns and negative returns equally. So a huge spike to the upside drives a volatility statistic just as much as a huge dive downwards. Second, volatility expands exponentially. Again, My daughter could tell you how squaring works. You know, if you square 2, you get 4. If you square 3, you get 9, and so on. So the measurements that you see in the press or in academia of volatility make slightly more volatile moves seem even more volatile. Third, the last thing I want to point out is that the T for time that underlines the divisor of this. That means that the longer the time frame you look at, the smaller the end value should become. Over a theoretically long enough time frame, volatility actually approaches 0, and that's just the nature of the beast when we're talking about these statistics. And that's not to say that markets don't move over long periods of time. Of course they do. But it does mean that the range of measured variance narrows the longer and longer you look when you look at longer averages. So here we have the 3-year and 10-year rolling index returns for the Dow Jones Industrial Average, taking from the start of every quarter between 1900 and 2009. And as you can see, and as you might expect, the 10-year rolling returns fluctuate within a much narrower band, about -9% to +16%, than the 3-year series, which goes as high as 42% and as low as almost 50%. In other words, under a 10-year time horizon, periods of both positive and negative stock performance become much more muted. And that should match up with your intuitive sense of risk. Long time horizons means you just care less about short-term swings in your portfolio or short-term swings in the market. So volatility clearly depends on the time frame. So for investors, the question becomes, what's the right time frame to look at? This chart looks at the volatility of the S&P 500 over 3 very different time frames. The white line looks at volatility of a rolling 1-week return. The orange line looks at the volatility of rolling 1-month returns, and the green fat line, which is the easiest one to read here, looks at the quarterly results. So not only are the absolute numbers bigger on the shorter time frames, but the results are more volatile. In practice, it's probably a good idea to look at volatility and look at the volatility of your returns as it relates to your actual rebalancing period, whether that's once a year, whether that's once a quarter, whether that's once a month, because that's the volatility that will actually impact your portfolio the most, because that's when you're making trades. But this is also an object lesson in self-restraint. We're conditioned by the media to pay attention to, in big quotes, what the market's doing. And all too often we get very fixated on what the market did today or what the market did this week. And honestly, if your time horizon is really just 1 week long, let's face it, you're really not investing. You're a day trader, not an investor. And you'll want the most volatile investments you can find. So your whole approach to volatility would be very different if your time frame was truly just a couple of days or a week. It's important to note that the historical measures of volatility we're discussing come with a lot of assumptions. And among that, the biggest assumptions is that returns are sort of normal, that is, that they follow a bell curve. There's also the more insidious problem that most of these measurements of volatility assume that upside volatility, happy surprises, are just as bad or as good as downside volatility. And we all know that from a practical perspective, that's simply not true. People will spend a little to win a lot, like a lottery ticket, but they'll spend a lot to avoid a big loss. Think of health insurance or life insurance or house insurance. Investment results are often skewed in one direction or another. They can also suffer from kurtosis, where the tails matter much more than the belly of these kinds of returns. So the question is there a better way to think about this? Is there a better way? And the answer is, well, yes, but as with most things in academic finance, better ways get more complicated. From a pure academic perspective, modern finance has things like skewness and kurtosis that let us measure things. So it's easy to look at a chart like this one, which I pulled up this morning for SPY, and say, gee, that looks pretty normal. But the reality is it's got all sorts of skewness and kurtosis going on underneath it, ways of measuring just how non-normal the last 2 years of S&P 500 returns have been. And there are very sophisticated asset allocation models that try to incorporate that. Now, how you actually dig into that and feed this into asset allocation models, et cetera, would be a question for another day and a whole big topic all by itself. But for those that are really trying to dial in their risk projections, feel free to drop me an email, and I'll send you links to some asset allocation software that deals with this, and a few books that you could probably use for sleeping pills. But there are ways of measuring those trickier aspects of return distribution. One last thing I'd like to note before we move on, the volatility we've been talking about here is really dealing with the past. In other words, what happened, the historical volatility. Often, however, we want, as investors, and often we'll find any way we can to measure the future, a guess about the future. And that's when we turn to the options market and this idea of implied volatility. So implied volatility is an estimate of how volatile a given security is going to be going forward, usually over a 30, 60, or 90-day window. And it's based on the cost of the options tied to that security. Implied volatility assumes that the demand for options reflects the market's best estimate of how variable a security will be over time. So the higher the volatility in the underlying security makes the ability to buy or sell it at some point in the future much more valuable, and therefore options with higher implied volatility have higher premiums. Options with low implied volatility have lower premiums, and so on. So what's interesting is that implied volatility often increases in bearish markets and decreases in bullish markets, since investors tend to believe that rising markets are riskier than falling ones. That's not actually true, of course. It's just that volatility is moving returns in investors' favor. In particular, take a look at what happened here back in the crazy days of 2008. Looking backwards, which is the orangish line here, you can see it was a period of crazy volatility. We almost hit 90%, and it lasted for a good solid month. But at the same time, the forward predictions of volatility, the implied volatility, simply never believed that the real world could be that crazy for that long. We'll come back to this towards the end when we talk about the VIX in particular, but I wanted to just put a placeholder here for us to take a look at what really happened. So now we turn to what investors really care about, which is the impact this volatility is going to have in your real portfolio. And in short, this impact is large, and I think most investors get this intuitively. So let's just consider two imaginary ETFs I made up. ETF A is a steady eddy. It grows 10% a year each and every year without fail, and its standard deviation therefore is 0. It has essentially no volatility at all. And as you can see, it would be a great ETF to hold, that top blue line. And if you can tell me where I could buy these returns, I'll sign right up. $100 invested in this in year 1 turns into about $270 over the course of the decade plotted here. And you can just take it to the bank. Now let's consider its cousin, ETF B, which is much more of a crazy eddy than a steady eddy. It bounces around like a rabbit on sugar, up 10%, down 10%, up 30% next year. And on a lay level, when these ETFs are reported, when people talk about what the average growth rate of these, they're both going to show up as 10%. Now obviously, their real return, their cumulative average growth rate, isn't that. But on any given year, if you just take the averages, and that's what often gets reported, they're both going to look exactly the same. Fighting volatility, ETF B delivers a substantially lower long-term return. So understanding the volatility of annual returns is critical in understanding what the end value of your dollar is going to be. It's also critical in understanding the risk that if you have to withdraw your assets on any given day, you might be above or below some trend line you were expecting. And that's why it's so important to really understand the volatility of a particular investment. So what does all this academic finance get you? Well, look at the risk of individual securities, indexes, or ETFs. That's what it does. And the information can also be helpful in building portfolios. So this table looks at annualized volatility for several asset classes. Specifically, we're looking here at the average 30-day volatility over a rolling window in the last year. You could do this for a full quarter, which might be more appropriate for your rebalancing window, but I like to look at a month. So either way, the numbers will be surprising. On a summary level, a few things might jump out at you. First, bonds. There's bonds and there's everything else. And if we're being honest, the low volatility of the Barclays aggregate is driven by its huge treasury holdings, and that's the reason we call those things the risk-free asset in most of our equations. But even high-yield bonds, which are supposed to be risky, at least by fixed income standards, aren't hugely volatile. Some other things you might see that might surprise you: small caps, are more volatile than commodities, and foreign stocks are more volatile than U.S., and gold is only slightly less volatile to the S&P 500. In fact, sometimes gold is more volatile than the S&P 500. This chart looks at the rolling volatility of gold and U.S. stocks over the past few years, and you can see the gold volatility spiked around year-end when gold had a big rally and dip. And more recently, equity volatility has been increasing as the markets have been rattled by the risks of the double-dip recession. But it's definitely a dance between the two. To say that gold is flat-out less risky investment is simply not true by any academic measurement of the reality of the returns, regardless of what the headlines tell you. So I have plenty more to say on this topic, but before, I'd like to kick this over to Joanne, if we can unmute her. Joanne, you've recently done some interesting work here on putting volatility in a historical context, and I'd love it if you could walk through some of that for us.
Great. Thank you so much, David. And I'm going to be talking about some specific examples and some of the same themes that you brought out in your discussion. But I think it will help, hopefully, to reinforce and improve people's understanding of the concept. It certainly received considerable attention in the press over the past few years, but what is often glossed over is that there are many different dimensions to volatility. I think investors know generally that volatility is a key measure of risk, but it's often intertwined with return when people think about it in the investment process. And also, the concept of volatility means different things to different investors. It's in the eye of the beholder. And so it depends on the context and very critically on the reference time period. So I think we're going to bring out here in particular the important role that time plays in understanding the dimensions of both return and volatility. While many people are long-term investors, they really are often concerned about short-term fluctuations in the value of their holdings. And this is why CNBC has so many viewers. They do consider rebalancing, making changes at interim points, very often months or quarters, especially when market conditions change. So in my segment of today's webcast, I'm going to touch on some different dimensions of volatility, which you see up there on your screen. First, I'm going to continue this discussion of the time dimension. Looking at volatility levels across different periods, it can provide very helpful insights. So I think that we'll see that shorter-term measures have much wider ranges than longer-term measures of risk, and that whether you're looking at a short-term or a long-term measure, that they all vary over market conditions. They are dynamic. If we look at volatility over time, I'm going to show that it follows particular cycles, that there are cycles that rotate from periods of low to average to short bursts of higher volatility. And some of these cycles can last years. And our research shows that spikes in short-term volatility have historically preceded shifts in longer-term volatility. Not every burst of short-term volatility has led to a higher sustained period of risk, but many of them have. Also, I'm going to talk a bit about the correlation and trends in volatility. Volatility has a tendency to trend much more than does returns. And also, across indexes, we do find volatility correlated, just like we find return correlated across indexes. And so I'm going to walk through some correlation analysis, and you'll see some of the results in this area. Lastly, I'm going to talk about the portfolio implications of changing volatility. I'm going to suggest that monitoring 90-day volatility can help identify potential directional trends in longer-term volatility. And I'm going to wrap up in discussing some trading strategies at a general level for different volatility environments, and I'll hand it back to Dave to go deeper into that topic. By way of, for simplicity's sake, we're going to stick just to the key elements of volatility, that is, talk about returns. There are other factors that influence actual return volatility, such as trading costs and liquidity issues. But let's get started by just looking at historical volatility for the S&P 500 over different time periods. So in this slide, I think you've probably seen something like this before because data is available for the S&P 500 back to 1926. So what we have here in the blue line going back to actually 1928 is the annualized volatility of S&P 500 the blue line is the quarterly volatility of S&P 500, and the orange line is the 12-month volatility of S&P 500. And so the blue is a shorter-term measure, but they're both expressed in these same units, that they're annualized. So volatility, just like bond yields, is often expressed in an annualized form, but it can be measured over a quarter, as in the blue line here, or over 12 months, as in the orange line. And so what you see here for the S&P 500's long-term history of volatility is pretty typical for global indexes. And what the data show is basically two types of risk regimes. If you look at the time period between 1940 and 2000, this is a 60-year period, the dominant volatility regime in the U.S. You see that it's characterized by multiple year periods of low to average volatility levels. There are some short bursts of high variability of returns. And over this 60-year period, the median level of quarterly S&P 500 volatility measures, as depicted in the graph, was just under 12%. Now, this is actually more than 1% lower than the entire time period from 1928 to 2008. So this period was a period of lower volatility than we've experienced in the recent 12 years. And if we look at the last 12 years, that is 1998 through 2009, this is an unusually high-risk financial market environment. And we can see here that, you know, over these periods, S&P 500 quarterly volatility reached maximum levels and was above the long-term median well over half the time. So, as I said, this analysis seems to indicate that volatility measures follow cycles. Volatility metrics measured over the year, the orange line, is similar to the blue line, you know, over that 1940 to 2000 period. So when volatility is at the lower or average level of the range, there isn't that much of a difference between short-term and longer-term volatility. However, when risk increases, the shorter-term measures move much higher than the 12-month measures. And certainly this has been front and center for us in the last 12 years. And we can also see that these spikes in volatility measured over quarters give early warning signs of higher risk over longer annual time frames. And so even for long-term investors, we argue that quarterly volatility or possibly even 30-day is something that investors may want to be monitoring. And this is probably why they look at some of the shorter-term measures as are reported in the financial media. Now, the next topic I want to talk about is this concept of a trend in volatility. And there's a common statistical measure used to test whether a time series is trending, and that's a term called serial correlation, looking at the extent to which consecutive periods of returns or volatility levels move similarly, move in the same direction. And what the table is showing is in the first two bars, a 60-year time frame, 1950 to 2009, and then 20-year subperiods. And we show this for return, serial correlation of return, and volatility. And what you see is that these measures are fairly low, or definitely closer to zero, for serial correlation of S&P 500 returns from one quarter to the next. So this is the base data here is quarterly. So these results range from plus 0.1 to 0.15, a little bit of positive serial correlation, but not much of a trend. On the other hand, if you look at the trend in volatility, you see much higher levels of serial correlation, especially over the last 20 years, 1990 to 2009. So we can see here that volatility has a tendency to trend much more so than return. Now, the next topic that I mentioned we'd address is how correlated is volatility across your portfolio. And there's been quite a bit of attention to the fact that return correlation rises in volatile market conditions, especially those that are volatile to the downside. And many investors are concerned about the ability of diversification to help reduce risk when return correlation rises. And, you know, I think we all know that there are many reasons for this higher correlation effect. When we have volatile markets, we see economic pressures affecting many companies simultaneously. We see investors moving to reduce risk across different types of assets that can widen trading spreads. And we can see investors moving out of liquid assets, perhaps if they face margin calls or attempting to raise cash. But I think that what we wanted to do was compare correlation across indexes. And so we looked at a number of popular global benchmarks and other broad benchmarks of the U.S. market from 1995 to 2009, and we looked at the correlation of volatility measures of these indexes to S&P 500 volatility. And we see that the correlations were high for return, ranging from 0.84 to the NASDAQ 100 to S&P to 0.95 to for the Dow Jones Industrial Average. But we also see that the correlation of volatility is close to the same level, and for many of these indexes, even slightly higher than the correlation of return. So this means that portfolio risk tends to rise as market conditions become more volatile. Or when it increases for one index, the other indexes are increasing higher volatility as well. So how can we put this in perspective across several market segments, but also capture the time element? At ProFunds Group, we recently published what we think, and we hope you agree, is an interesting reference tool that's on our website, ProShares.com. This is a two-page document called Volatility in Perspective, and I hope you all go to our website and take a look at this. I'm going to be showing you some snapshots from it as we move into the next two slides. So what this brochure does is it displays historical volatility measures for 39 indexes, representing a range of asset classes and getting down to the sector level for the U.S. market. And what we're doing in this type of graphic is trying to give you a comparison of volatility across indexes by the placement of the ranges of volatility on this exhibit. And then we're also trying to show you how volatility behaves over time. Okay? So what you see here, and what I'll be talking about in this exhibit, is you'll see the median volatility measure, the median 90-day volatility measure over the 10-year period 2000 to 2009. And you also get a feeling for the range of 90-day volatility rolled daily over this 10-year period. And we show this range as in percentiles, the 5th percentile, 25th percentile, 75th, and 95th percentile. And I'm going to walk you through an example of this for S&P 500. So if you look at the third row there, you see S&P 500. And you can see that the median 90-day annualized volatility was 17.1%. This is over the entire period. You'll also see on top of the range bar that 27.3% was the volatility for 2009. We wanted to show you that number because it's a recent number and give you a sense of where we've been, at least in that calendar year. If you look at 8.7%, through all of the 90-day rolling volatility measures over this 10-year period, 5% of them were lower than 8.7%. 5% of them were higher than 40.3%. And the maximum 90-day volatility for S&P 500 over this 10-year period, if you keep your eyes moving to the right, was 73%. The average daily move is another statistic we show in this brochure because we know that a lot of people are really looking at day-to-day changes, day-to-day returns. And so for an index like S&P 500, the average daily move over this 10-year time period was 0.65%. So from this, you know that if you see the S&P move 2% in a day, it's a volatile day. Okay? So now that I've dug in a bit on one index and showed you how to read this, I think that what you can see that we've given you a snapshot across a lot of different markets. In this particular slide, we show some fixed income, gold, as well as emerging and EFA. And one of the takeaways is that basically, you know, if the lower the median level, usually the tighter the range, although there's some exceptions to this that I'll point out, especially for the sector indexes. So, for example, the Barclays Capital 7 to 10-year U.S. Treasury Bond Index, right, has quite a low median, 6%, and a very tight range of volatility over these 10 years, compared to the NASDAQ 100, where the median level 23.9% and a very wide range. Another interesting point is to look at the 90-day volatility levels of the MSCI Emerging Markets Index and the EFA Index. You might be surprised to see that the median volatility for these global or international indexes is actually lower than the S&P 500. And the range is not much wider either. In fact, it's just a bit wider on the high side. And I think this is attributable to the fact that, first of all, the EFA Index and the Emerging Market Index is diversified. It's diversified across countries. And I think it also is lower in risk slightly, because in the U.S. we certainly experienced the worst part of the financial crisis was in the U.S., so that affected the risk of the S&P 500. And I think that what you also see in this chart is that the high end of the ranges, the 95th percentile, is much more above the median or normal level than is the low end. So you can see that when risk increases, it will increase, it's not symmetric. It will increase to quite a high level relative to normal market conditions. Now let's turn and take a look at some sectors. So this is another segment of this chart that we have, a brochure on our website. And here, if you look at this, you get some things that you probably would expect, that some sectors have higher risk, and these riskiest sectors are ones that you would probably normally think of, like semiconductors and technology and oil and gas, basic materials. And you'd see that the consumer goods and the healthcare sector are among the lowest risk. But you also then can take a look at what has been experienced by real estate and by financials. They have experienced very wide swings in volatility, that their median levels over the last decade are relatively low, but the 95th percentile was 96.3% for real estate and 89.1% for financials. And I think we all know what that came from, related to the housing market. So we've seen how that volatility is multidimensional. And now that we're armed with a better historical perspective, what does this mean for your investment process? I think we'll go to the next slide to discuss that. A first step in dealing with changing volatility, and volatility that varies across indexes, involves monitoring. And, you know, I tend to monitor the 90-day volatility because I focus on quarters in my portfolio, and I think many other investors do as well. And I like to compare it to the median and to this range. And this then helps provide insight into whether volatility is trending higher or lower. And what might be some plans or things to consider once you reach a conclusion of whether you're in a falling or rising volatility regime or a high or low regime. First, it might, if you think that you're in one of these periods of high or rising volatility, it seems that, and hopefully we've convinced you, it might be time to look toward more defensive portfolio tactics. And that is to consider adding or increasing positions that have low or negative correlations to the primary sources of risk within your portfolio. This is normally done by shifting to cash, considering lower risk securities or strategies. Some investors might also consider attempting to use some hedging strategies to reduce volatility exposure at these times. And these can include put options, inverse mutual funds or ETFs, short positions, and for institutional investors who have access to these products could also utilize futures or swaps. There's also the situation you might find yourself in where you see signs of volatility falling, approaching historical averages, or even going to very low levels. Well, this would very obviously be a sign to consider shifting out of defensive into more aggressive positioning of the portfolio to benefit from volatility going lower. Some investors sell options in this type of environment. Others utilize leverage or higher beta strategies, which can be done with mutual funds or ETFs. And there are also opportunities to take a direct view on changes in the expectations of the market for volatility. And Dave's going to comment on some of this as I turn it over to him. But I think we expect to see more products available that will allow investors to take a view directly on volatility. And perhaps, Dave, you could give us a little introduction to some of those.
Sure. I understand some folks have had some problems with slides. Apologize for that. We'll soldier on and do the best we can. I'll remind everybody that slides will be available on our website and I believe at ProFunds shortly after the event, as will a replay of the webinar. Let me change this over to the correct slide. Okay, so let's talk a little bit. About VIX. As Joanne was saying, you know, it is the measure that is most widely used as a barometer of the overall market. Overall market volatility. It was introduced in a paper back in 1993, and it wasn't actually possible to invest in this benchmark until 2004 when the CBOE first launched derivatives products based on it. The VIX is an index of options, not equities. Originally, it tracked 8 at-the-money options based on the S&P 100 index, such that its value always represented the implied volatility of those options with exactly 30 days until expiration. The index changed substantially in 2003 in order to more accurately capture how investors think about future market volatility. And so the VIX now pulls from the much broader S&P 500 index, and it tries to address volatility skew by pulling from options with a much wider range of strike prices, not just the ones that were right at the money. The old way of measurement still trades, by the way, under the ticker VXO, so you can see the difference. So if VIX is an up-to-the-minute market estimate that predicts how options think about the S&P, what does that actually mean when you hear a VIX value quoted or put on the screen at CNBC? That is, if the VIX is, say, at 10, what does it actually mean? Well, it means that the market expects that over the course of the next month, the S&P 500 will see an annualized change of about 10%. Now that translates to an expected up or down movement of about 2.9% over the next 30 days using that formula here. So you always have to go through this little bit of math to figure out what does it really mean. Because the VIX changes in real time, it's often referred to as a fear index or a fear gauge. That's a bit of a misnomer. A high VIX value isn't necessarily a bearish sign for equities, and we talked about that before. You can have volatility on the upside as well. In the options market, that would translate to the call options trading at substantial premiums in anticipation of a large move to the upside. Those higher call prices would raise the VIX just as surely as higher prices would. As you would expect, you do see the VIX spike when the market crashes, as this chart shows. But those movements are typically reactive, not predictive. So one thing to keep in mind is that VIX is far from perfect, and there are often short-term swings in volatility that simply never materialize in the actual markets. I'll refer back again to that craziness in the fall of 2008. The actual volatility of the stock market stayed high while VIX essentially crashed, and that was because options traders simply couldn't believe that kind of volatility would persist, and it did. the historical data shows that VIX is also mean reverting, meaning it has a tendency to decay back towards a status quo after particularly spiky periods. But it doesn't happen immediately. It can take a long time, and to paraphrase Keynes, the market can stay crazy a lot longer than VIX can stay elevated. Again, you see a similar reaction over the past year. When the volatility of the actual market was quite low, VIX remained high. It's important to never forget that VIX isn't volatility, it's a bet on volatility. Now, over the past 10 years or so, as volatility in the market has surged, so too has the VIX, and interest in it has gone haywire. Investors hoping to mitigate their downside risk have looked for ways to use VIX and volatility in general to hedge their exposure. And several options have come to market in recent years. Let's start with the most basic. I mean, a lot of people jumped to the VIX bandwagon because really they want to hedge against high volatility, but if we're honest, that's not what any of us actually want. What we want is to hedge against a severe loss in our portfolios. And honestly, for this simple target, there are much easier ways to get exposure you need without messing with any of this statistical mumbo-jumbo. Simple diversification is the best place to start. You know, the old rule about putting parts of your portfolio in stocks and bonds and alternatives really does actually work and provides a cushion when one market gets extremely volatile. Other strategies, things like long-short approaches and option straddles, also can reduce risk. One of my favorites that I think is generally underutilized is the idea of a suicide put. A suicide put is a deep out-of-the-money put that you buy to gain protection from a severe price drop in the market. So if you're worried that the S&P is going to drop 30% over the next couple months, well, I mean, I did a quick look before the webinar. SPY was trading at about 111. You could have bought puts at $85 for about 50 cents for October. You could even buy tighter protection, say, for 100 for October for about $1.50. And if you're really concerned about volatility in general, you could buy puts and calls together to profit from the S&P moving out of a tight trading band at all in either direction. If you do, in fact, want to play directly with volatility, not just hedge your market exposure, the classic place to start is in derivatives, like futures and options. You can now buy futures and options based on VIX, which have several benefits, not the least of which is that futures offer a different kind of risk and return profile, so they bring a level of diversification in themselves. But there are drawbacks. Futures and options are often off limits for some investors' accounts. The price of entry can be quite high. You know, one VIX contract is $1,000 times whatever the VIX is trading at. Also, VIX futures don't actually track VIX spot prices, just like oil futures don't track spot oil. Instead, the VIX futures track the expected price of VIX at some time in the future. And so if you look at the lower right-hand corner of this slide, for those of you that can see it, you'll see the contango that just has persisted over the years in those VIX futures. So over time, that contango makes it a money-losing asset, especially since we just discussed VIX is ultimately mean reverting. Now, these problems haven't actually stopped anyone from owning or trading VIX derivatives. Volumes are through the roof since inception, and now more than a million VIX futures contracts trade hand every year. You can also access volatility with exchange-traded products. There are exchange-traded notes available today on VIX futures. The bulk of the assets the bulk of the assets focused on the near term. They've raised about $2 billion, so they've obviously been quite successful. But again, I point out again that these indexes, these products track indexes that don't track the VIX themselves. They track a group of VIX futures, which again are a bet on the future value of VIX. It's a bit like betting on what the weatherman says the 1-month forecast is going to be when the paper comes out next month. An actual future strategy suffers from both this noise and the crippling contango, and this chart shows you what a hypothetical investment in the VIX itself, which is that top line, which you can't actually make, would have returned versus the VIX futures investment, which is that yellow line that doesn't look so good. That pink line in the middle that actually looks pretty boring, that's actually the S&P 500. Another way to play this space, and we'll talk to Tim about this in a bit, is through inverse and levered ETFs, which offer some daily multiplier of some benchmark, and because of that, the returns tend to compound in trending markets and deteriorate in a trendless volatile market. So in a trendless market, you can actually short that deterioration effect and thus cash in on the volatility. Of course, trending has a much higher effect on the performance of leveraged or inverse ETFs than just volatility, so using leveraged or inverse products to profit from a volatility spike only works in a trendless market for the most part. What's more, the strategy requires some substantial mental fortitude to carry off. Dealing with leveraged and inverse funds is not a strategy for buy and hold or easily spooked investors. But luckily, one of those investors who's not easily spooked is Tim, one of our panelists today, so we'll be sure to grill him about this in Q&A. In conclusion, before we go to Q&A, I would just say that volatility is a complex beast, and investors should not forget that risk reduction is about a lot more than just containing volatility. It's about understanding your exposure, understanding your downside risk, understanding how diversified your portfolio is, even how the different assets in your portfolio are correlated. On that note, I think it's time to open up the discussion to our Q&A portion, so I'll turn it over to our panelists. I wanted to remind you that you can enter questions at any time using the Q&A panel on your screen. We'll roll up the questions and pass them along to our panel. So joining me again today are Tim Collins, founder of Tangle Trade Management, and Joanne Hill, head of investment at ProFunds. Tim, are you there? Joanne, are you there? Ashley, if we could go ahead and unmute our panelists, that would be great.
Okay, I think we've just been unmuted.
There we go.
Hey. Tim?
Hi, Joanne. I think we're waiting for Tim to get back in. So let me toss a couple quick questions at you. You talked about sort of the cyclicality of volatility. Maybe you could just sort of give us your opinions about why that might be the case. Why do we see that cyclicality and volatility?
Well, yeah, that's a good question. I guess, as I mentioned, we see these periods of big bursts moving to significantly higher volatility regimes, and they don't. When they happen, they often accompany significant bear markets, recessions. So usually, it's associated with economic weakness. And as we know, recessions don't come 50% of the time. They come in episodes, over decades. Some are more severe than others. And so usually it's associated with volatility in economic earnings to the downside that causes investors to significantly modify the risk postures of their portfolios. Some people think that the very highest volatility comes because many more investors are seeking to trade at the same time to reduce risk than under normal market conditions, and this can sort of lead to multiple days and sometimes even months and quarters, as we saw in 08 and 09, as different investors come to the table every day to try to turn down their risk. That begins to have a price impact because that looks like high levels of volatility and is persistent. So so basically, unexpected or negative things happening in the economy, then get connected to changes in investment policy and practice, and can lead to volatility. Now, I will mention that there was a very notable period where we saw a rising market and rising volatility. I think that most people, if they think about it, will probably guess when that was, 1998 and 1999, the period of what a lot of people call the technology bubble. So that was a period where people were running all at the same time to add risk to their portfolios, especially technology exposure, and that led to some price impacts of that desire to increase risk. That where people were experiencing, the markets were experiencing higher volatility on the upside. But generally speaking, we see volatility rising in bear or severely down markets.
Right. Well, we don't seem to have Tim at the moment, so I've pulled in Matt Hogan here from Index Universe because Matt and I spent a fair amount of time talking about these. So I was going to drop a bit of a pop quiz on Matt here. Matt, do you think when you're looking at volatility, we've looked at a lot of these charts over time, do you feel there's a self-reinforcing problem here where volatility begets more volatility? I mean, is there a reflection problem in the markets?
That's a good question. I'm not so sure that's true. I mean, maybe it gets stirred up a bit on CNBC as people report these high VIX numbers, and everyone, begins to fret about the market because they're fretting about the market. But more to me is actually the reverse, right? The mean reverting nature of volatility seems like the dominant trend, and we see these enormous spikes, and everyone panics. But the nature of those are short, and things do tend to return to normal. I think that's a factor that people seem to miss. There's been all this concern about volatility over the last few years, but when you look at the data, until recently we were at absolute historic lows, right? So you do have spikes of volatility. I don't see it as self-reinforcing. I see more of this regulation and reversion to the mean.
Joanne, you sort of toss a little bit of advice out there when you say it may be appropriate for folks to be monitoring volatility the same way they monitor, say, the pattern of returns on sort of some rebalance period, 90 days or a 30-day window. From a practical perspective, not everybody has a Bloomberg sitting on their desk. How do you go about actually tracking that? I mean, how does an average investor really monitor their volatility?
Actually, this is pretty easy as long as you have access to the Internet. To measure actual volatility, all you need is daily returns or percent price changes of the index you want to look at. Okay, so what you would do would be you would get the series of index levels. If you load them into a spreadsheet and calculate percent changes. That would give you the percent change every day of that index. And then, so let's just say you did that over 90 days, so you have 90 numbers of daily percent changes. Well, what volatility is, it's just kind of the average of each of those days' deviations from the average return. So rather than calculate it yourself, I just use the standard deviation function within my spreadsheet calculator. So if I do that to that column of 90 numbers, I get the standard deviation of daily returns, okay? And what I need to do to convert that to an annualized number, which is the number that we have on our brochure, is roughly multiply it by 16. Why 16? Because there are about 256 or 260 trading days in a year, and the square root of 256 is 16. You don't need to know why, it just works. So take a daily return series over 30 days, 90 days, calculate its standard deviation using a calculator or a spreadsheet, and then multiply it by 16, and that gives you the current annualized volatility. Does that help?
I think that covers it. It might be a little bit of a brain bender for people, but we'll put some links up where people can drop me a call.
You can do it. Most people can do it.
Tim, do we have you back online?
I think so. Can you hear me?
There we go. Hi, Tim.
I'd say the volatility is pretty high on getting into the technology here today.
I think so. So Tim, let me go back to the question I was going to start with you on. I mean, you're one of the more aggressive users of ETFs I know. How do you decide when to approach volatility as a thing to be captured, measured, and exploited in your clients' portfolios? What do you look for?
Actually, we try to capture it on a daily basis. We don't put a fast measure on it, basically saying, it's got to be here, it's got to be there. Now that being said, I do chart out the VIX and on breakouts where we certainly want to capture that type of move anytime there's a large move to the upside, the volatility index or the VXX. We want to try to capture that, just playing the idea of reversion to the mean. But on top of that, I mean, we use volatility more as a hedge, knowing that when the market is less volatile, when we've seen volatility come out like we have recently, we'll actually go in and start buying protective puts against a portfolio as a long-term hedge. And we'll be buying puts, though, on these leveraged longs. So something like SSO or UPRO, the ProShares 2X or 3X S&P 500, simply because, when you're playing that idea of a low volatility, kind of like we talked about on here, that seems to be the time to get involved in volatility, not when it's high. It's already too late then. We're going in and we're actually looking for that increase in volatility to have, that long-term drag effect on an SSO or a UPRO. Not that they're not doing what they're supposed to, but that's simply how the products operate. And so what we're looking to do is, we provide the ability to still grow long-term, but also if volatility comes back into play, we provide some protection to the downside, and we can still make money even if the market just moves sideways in an up and down fashion, which we can see a lot when volatility picks up these large drops and these large swings back up. One other simple thing that we do is, the old notion of a covered call. The old notion of a covered call is you own the S&P 500 or you own the SPY. And people would sell out of the money calls against it. Well, instead of selling out of the money SPY calls, we'll look at selling out of the money SSO calls or UPRO calls. And we're doing that in a fashion where it's dollar proportionate, so it's, you want to make sure you factor out the leverage and make it 1-to-1. But you want to take a look at when there's a spike in the market and you see the spike in volatility of being able to capture some of that premium, similar to how you would do selling a covered call against the S&P 500. But because volatility doesn't tend to just get sucked out of the market in a single day or two, we want to try to take advantage of the up and down movements or the potential volatility decay associated with those products. And there's obviously multiple ways that you can attack this, and it's, things that I write about. But these products allow for just a twist on the traditional approaches to protecting portfolios or hedging portfolios and garnering some of this volatility without having to play the VIX or those ETNs.
Right. Right. I mean, Joanne, one interesting question that we got from the audience, you spent a lot of time, analyzing these volatility numbers, looking at the correlations across asset classes, looking at the correlations to returns. From the trends that we've been talking about, can you actually imply a bullish or bearish signal for the market price level for the next 12 months by looking at the particular pattern of trends in say, the last year's worth of volatility? Can you use it as a forecasting tool?
Oh, there's a lot of different opinions on that one. An article's written, I'm sure if you searched the VIX as a market signal, you would probably come up with quite a few, or realized volatility as a market signal. I think that some of the research that I've done in the past it shows that generally speaking, when VIX gets extremely high, that can be a bullish signal. Although, you can be in big trouble if you're too early on that one. But I think that the evidence on high levels might, being preceding bottoms is somewhat stronger than anything else from the articles that I've read. I haven't seen anything else that has convinced me that I can use it as a market directional signal. But some people do certainly feel that it has information of that nature in it.
Well, Tim, let me turn the question to you with a slight twist from one of the questions from the audience. We've talked about being diligent and monitoring the volatility of the assets in your portfolio. If you're not sort of trading it as a signal, if you're not saying, oh, volatility's high, I want to capture it this way, how can you incorporate that into just your normal analysis of, say, your quarterly rebalancing of your portfolio? Do you look at historical volatility and say, hey, you know what, SPY doesn't look like SPY looked when we put it in, and so we should reevaluate, sort of say, the asset, the value that we're putting into a particular asset because it's changed, its volatility has changed?
Actually, I think that is one thing that you have to do. We tend not to do calendar rebalancing. Simply, we prefer to do more target or number driven, simply because a calendar is kind of arbitrary. I can pick a month or a quarter or semi-annually, but it doesn't tell me if volatility has changed. If you do it quarterly, you may miss the biggest change or the biggest risk change to your portfolio happen during that 3 months, and you're not looking at it towards the end. But what we'll tend to do is we'll look at something like an average true range or an ATR. And if we start seeing a big spike there, which is reflective in your volatility, yeah, we're gonna look to lessen that position, or we're gonna look to take more protective measures against that position. Yes, it can signal maybe there's a renewed interest or some momentum coming into it. But for us, we place a target on what that true range is, which is really a reflection of volatility. And if it becomes too much, surpasses a historical threshold by 20%, what we look to do is we want to hedge out that position, or we want to try to take advantage of knowing, hey, there's an increased wider range of movement here, and that kind of comes back to, well, how can you use these leveraged ETFs? You don't necessarily have to eliminate your position. You can maintain it where it is and then just apply, more modern hedges or more modern paired techniques as opposed to just going smaller.
Right. I mean, is there something that you look at other than simple standard deviation to really assess the risk in your clients' portfolios?
Well, that's the average true range. That's on top of the standard deviation. That's the other thing that we will look at. Since we do rely on technical analysis, if you start seeing much wider swings in the slow stochastics or much wider swings in the relative strength, those should be warning signs that, hey, the historical implied volatility on the options are X, and historically I can look back at the charts and see that they ran in this this pattern and these numbers, we call it Y. Well, now all of a sudden it's X times 2 and it's Y plus 50%. That becomes worrisome. But I think you can focus on standard deviation measurements or offshoots of standard deviation measurements as opposed to just picking something historically.
Yeah, I was just going to jump in here. I think that a simple technique to be monitoring is, just using these daily returns or percent changes in the index. You can go back and say, okay, over the last 1 year or 2 years, take the absolute value of those daily percent changes and see what it was. And if it was 1%, and over the last 10 days you're seeing an average absolute move of 1.5 to 2%, that's probably a pretty good indicator that conditions are changing, right? So, and for that, you just need to be able, you just need to take, unsigned values or absolute values of returns and look at a recent period versus a longer period. That's usually a pretty good sign that the conditions are changing. I don't know, Tim or Dave, if you have a reaction to that.
No, I certainly agree with that, and that's kind of why we look at that ATR. Is you can shorten it or lengthen it and get a really good idea of hey, where is the true range? Because volatility doesn't necessarily can't always just be measured on the closing basis. Sometimes you have to look at that intraday.
Right, if you have a high-low data, a lot of indexes you can get high-low data for the ETF, so that you can even look at the high-low range, right? What's normal.
And I think that becomes, that might, and if we're looking for something forward-looking, that's data that we would consider, and that's data that we do look at is, what is even the range during the day? Maybe over this last quarter, historically it doesn't look like we're that wide, but if you look intraday, we're seeing these big swings, and that is something that is predictive of, okay, well, the comfort is not there, the volatility is there, but maybe it's not showing up on that closing basis, but more than likely that's going to tell us that there is more volatility to come, and we're not always going to stay in that narrow range.
Right. So, Joanne, maybe I'll just ask you sort of one final question here before we wrap up. We're running a little bit long. One of the things that was interesting in your study was to look at correlation, and if I read it right, we see that the volatility of asset classes is actually more correlated, say, than the returns of a given asset class. What do you think the sort of logical reason for that is? Is there something investors can learn from that?
Well, I think what we looked at in the study was the volatility of indexes, right?
Right.
And so that is why. So what happens is, it all comes back to the fact that individual securities move more together, right? When we get more volatile conditions. You know, so individual security returns become more correlated, and that happens to every index that you own, right? And so what happens then is index volatility goes up in almost every index from this higher return correlation going on in different segments of the market. So it's kind of the way that passes through to your whole portfolio, right, if that makes sense. Right. And so it comes back to the fact, so the reason therefore is that correlation changes over market conditions. The value or benefits of diversification change over market conditions, and you know, and we can see that from either returns getting more correlated, or from volatilities getting more correlated. But therefore, you know, therefore that's why I think more investors are looking to make modifications, whether you call it being tactical, dynamic, adaptive. So, you know, there are things that happen that might make you know, the risk of your portfolio is gonna change, and you might want to counter that in some way. Right.
Well, unfortunately, I think that brings us to the end of the session. I'd like to thank both Joanne and Tim for joining us today, and to ProFunds for sponsoring our session. For more information on some of the strategies we've discussed here, please do check out the educational materials available at indexuniverse.com and proshares.com. I'm happy to point people in the direction of some deeper materials if you drop me an email at dnadig@indexuniverse.com, which I put on the screen. For those of you eligible for continuing education credits, if you're attending this live, an email will go out to you in a few days with the information you need to apply for those credits. We'll also be sending a link out for a quick survey on this webinar, and we'd certainly appreciate any feedback you might have for us as we continue the webinar series. Thank you for coming, and we hope to see you at a future installment of the IndexUniverse.com webinar series. Good afternoon.
Thanks, Ed.